Hello, and welcome to our market alert video for today, which is October 6, 2023. I am Ken Moraith, and I'm founder and CEO of Retirement Planners of America. I'm glad you're with us. I hope that all is coming up roses for you, and that this video finds you healthy, wealthy, and wise. I want to dive into the news we got this week. The jobs numbers came in hot, more concern about the Fed raising interest rates and recession and all those kind of things. But before we do that, I want to share with you my oldest daughter, who gave us our first and only grandson, Nathaniel. He's 2 years old, went on vacation with her husband to celebrate her 5th wedding anniversary. And so we had Nathaniel for a week. And I've named that week the Taming of the Bucking Bronco. And so we went out to a restaurant to have a meal with Nathaniel. And of course, he's 2 years old, so he had one of those terrible 2 temper tantrums in the restaurant. So I picked him up, took him outside. The restaurant had a glass door, and I put him on the other side, and I said to him, okay, you're going to stay out here until you calm down. And when you're ready to calm down, we can go back inside. So I went back in, left him out there. I'm looking at him through the glass, watching him. And he, of course, is very headstrong. He wouldn't give in. He was in there, he was like mad and upset, and he's throwing a big temper tantrum. But finally, he calmed down. So I went out and I got him. We held hands. We walked back and joined Gigi, his grandmother, at the table. No sooner do we get to the table than he starts it up again. So I pick him up again, take him back out, set him down. When you calm down, you can come back in, waited him out. 3 iterations of this. But finally, he calmed down and we were able to have a nice, calm meal. It reminded me of when we were raising our 3 girls, that we had to do the same thing with them when they were that age. And the other thing that's really interesting is that when you're a grandparent, when you're a parent, rather, and your child is acting up like that, you're looking around at everybody because you're thinking, they think I'm the worst parent in the entire world, right? And so you're super paranoid. When you're a grandparent, you're like, okay, he's a kid. Kids do that. I'm just going to take him outside. So different approach. But I will tell you, I highly recommend the grandparent thing. If that works out for you, or if you're already there, it's really wonderful. So let's talk about last week. As we've been saying for almost all of this year, the inflation was not going to come down, and the Fed was not going to lower interest rates in the second or in the fourth quarter of this year. And in fact, we said that inflation would start to pick up again in the second half of the year, and that the Fed most likely would have to raise interest rates in the second half of the year. And sure enough, that's exactly what's happening. We also said that would bring with it what we call an inflation shock. That's what we branded it, meaning that the stock investors who are all, thinking that the market, that the interest rates were going to go down, and we had this huge rally in the market, those people would be disappointed, and we'd have a correction. And of course, that's what we're seeing now. Since the end of July, the S&P, the stock market, is down about a little over 7%, which qualifies as a correction. So where do we go from here? There's 2 sides of the argument right now. One is that next year we're going to see a 20-30% drop in the stock market because the Federal Reserve has overdone it. They've raised interest rates too high. They're choking off the economy. The real estate market's going to collapse. The consumer is not going to be able to afford anything because everything's so expensive and interest rates are so high. And we're going to have a big market crash next year. So that's one argument. The other side of the coin is that the economy is strong. We got jobs numbers this week, and they looked really good. So the economy is resilient. Inflation is starting to show a little bit of a sign of slowing down. So the Federal Reserve is going to engineer what they're calling a soft landing, right? They're going to land the plane softly, meaning not a big, bad recession. Inflation comes down. And if that were to be the case, then next year we're going to have a huge rally. So who's right? Well, as we all say, we don't have a crystal ball. So it's an educated guess by everyone. Our base case is the second. We're bullish. We think the rest of this year we're going to have this turbulence probably for another 3 weeks or so. The market could go down another 3% between now and then, but we think it'll rally into the end of the year and should be higher at the end of this year than it is right now. So we're on the bullish side of that conversation. But having said that, we could be wrong. And that's why we always say that you plan for the worst and you hope for the best. You don't do the opposite. That's not very smart in our view. Planning for the best, that everything's going to be rosy, and hoping the worst doesn't happen is not a financial plan in our view. And so that's why we have our invest and protect strategy to tell us, to get us out and to tell us to get out of the market, as it did in November of 2007 before the stock market crash of 2008. And as it did last April of 22, to get out, and you know what happened through the end of that year. It was miserable. Now, we're also continuing to recommend to our clients that they stay out of bonds. And the reason why is because if you watch my videos, you know that there's generally an inverse relationship between interest rates and bonds. As interest rates go up, bonds tend to fall. And again, last April, we counseled our clients to be out of bonds altogether, and we've continued to say that, and we think that we won't be changing that until probably April of next year, so another 6 months approximately. I want to share my screen with you and show you why we think that, or what has happened. So this is the BNY Mellon bond aggregate, which is what I'm using as a proxy for the bond market. And this goes back to April of 2022. And so what you can see is that when everybody was really worried about inflation and the Federal Reserve raising interest rates, you can see how much the bonds fell. We then had this really nice rally into March, almost into April. And this rally was driven by the thought that interest rates were going to come down towards the end of the year. Inflation was going to be under control. The Fed's going to have won the game and it's all over with. Of course, we were saying the opposite. We were saying, that ain't going to happen, kids. In fact, we think inflation is going to start going back up in the second half of the year. And that's exactly what is happening. We're seeing inflation rising again, and the potential for another interest rate hike by the Fed. And that prospect is what has driven the bond. As you can see, the bonds have really been clobbered and have taken it on the chin here lately. So we continue to recommend that bonds are not a good place to be for the time being until the inflation fight shows who's going to be the winner. And right now, the jury's out. So our view is don't be in bonds, be in stocks, but also make sure you have a protection strategy for your stocks. And if you don't have that, if you're over 50, if you're retired or retiring soon, then come visit with us. Get a second opinion. See if what we have to offer might be a good fit for you. Our website is rpoa.com, and click on Meet with an Advisor. We'll meet with you at no charge or obligation. We'll part friends regardless of what happens. Okay, so we would look forward to that opportunity. Our goal is to make you a SCWPR. And if you don't know what a SCWPR is a client of ours who is enjoying their second childhood without parental supervision. And SCWPR is the acronym for that. So we want you to be a SCWPR. So go to our website and maybe we can make that happen. Thank you for watching this video. Share it with your friends and family, and we'll look forward to visiting with you again next week. So see you then. Bye.